It's 15 minutes to 3 GMT. Now, in just a few weeks, the day will come when, in theory, America won't be able to borrow any more money. That is, unless Congress approves an extension of the debt ceiling, which is already at $14.3 trillion. Well, later today, the White House and congressional leaders will be meeting to try to persuade Republican politicians to endorse a rise in that ceiling. Otherwise, technically, America could be left unable to pay its bills and hence default. But how real is this deadline? Well, I asked Mark Bloomfield of the American Council for Capital Formation.
It's a deadline in a very unreal sense. That is to say, the consensus view among economists is that some magic day, our creditors lose confidence in the United States. They increase interest rates. That causes the stock market to tumble, consumer confidence, business confidence. We have a financial crisis. We have a hit to the economy. And that is a very ambiguous thing because we've never experienced it. It could happen before that magic date of August 2. So in that sense, I think there's no specific date per se. It's just an overall hangover of the U.S. economy and, quite frankly, the world economy.
But there is a certain legitimacy to the argument that unless America does curb its spending, then that is also going to poke big holes in international confidence.
Oh, no question. There's no question about that. I'm just saying it's unclear exactly when the tipping point takes place. I mean, it's very, very, very clear. In 10 years, our debt will be the size of the American economy. In 25 years, it'll be twice the size of the economy. The tricky question, which is obviously the most mainstream economists agree on, we cannot cut spending or increase taxes substantially in a weak economy. But on the other hand, we have to somehow magically signal to the markets that we have a long-term fiscal imbalance.
So with this magical situation, is it actually resolvable? It doesn't sound as if it is.
Well, it depends whether you look at the glass half full or half empty. One possibility is some significant package of fiscal containment and reform, which convinces the markets that the United States still is a strong economy, or a sudden shock to the economy by the financial markets. The latter would be a lot messier.
What form would that take? Just people suddenly scrambling to get out of U.S. debt, to get out of any investment?
Well, basically what would happen is our creditors would demand a higher interest on the money we borrow from them. Right now, my gosh, we're paying, 1 or 2%? Historically, it's 4 or 5%. That is a tremendous jump to our Treasury's fisc. When that happens, the stock market tumbles. Consumers lose confidence and they don't spend. Businesses are hoarding. They will continue to hoard. And the great unknown is how this can be contained. That really is the serious question once and if it starts. But it is an extremely perilous situation.
Isn't the big problem that there doesn't seem to be bipartisan agreement, that people are working against each other?
Well, that, of course, is the fundamental question before us, the politics of it. And the politics of it are very simply this, that the Republican Party, their litmus test is no tax increases. And the Democratic Party, on the other hand, at least a strong part of its base, refuses to cut spending. This, if you talk to seasoned legislators, political scientists, or others, is probably the most polarized situation we've seen in the United States since, let's say, the Civil War. So what happens? Again, the market reacts, or both political parties see it in their political interest to cut a deal. The Republicans don't want to be blamed for perhaps causing a financial economic crisis and perhaps agree to, quote, tax increases, which are not increases in tax rates. The Democrats give up their weapon of attacking the Republicans for throwing grandma off the health care system. And that's the only way that it could happen. It could happen at the last minute.
Mark Bloomfield of the American Council for Capital Formation.